today I saw your topic, which is very interesting. I already heard from my colleagues that this topic is very, I think it contains a lot of opportunities to attract people's attention. So I would allow people to ask a question during Sandrine's presentation, and so that we can have more active and constructive discussions. So, and thank you everybody, and welcome. Sandrine, now you can start your paper presentation, please.
Thank you, Bo. I would like to ask you a favor. Is it possible that people keep their question and ask them at the end? I will feel more comfortable.
Okay.
If you don't mind.
That's
if
great.
You don't mind. Thank you very much.
That's okay.
Okay, so today I'm going to present a topic which is quite different of the topic I am used to present, but it's also related to microfinance, because it's related to exchange rate. It's also related to trade between South-South countries. So the title of the paper is the following: Exchange Rate and Colonial Legacy, a comparative analysis of British and French former colonies in South-South trade with BRICS. So I would like you to be indulgent with me, because this is a very preliminary version of the paper. We work a lot on the data, so we weren't able to present you a very advanced version of the paper. So please be indulgent with me. So this paper is a joint work with two of my colleagues of the University of East Paris Créteil, Aya Bidewé and Françoise Vasselin. So let me introduce this topic by linking it with the literature on colonial legacy. So in this literature, others economists explain how former colonies' economies were organized so that they can serve as a market for metropolises. Indeed, we all know that colonization was made by former metropolises to find market for their industries, market to sell their final products, but also markets to have raw materials in order to provide them for their industries. So many articles will be interested in trade patterns between former colonies and metropolises, because this is the main sector of the economy that will occur with metropolises, former metropolises and former colonies. And when we look at the literature, many papers have been made on former British and former French colonies, because these are the colonies where we find a lot of data and where also the patterns seems to be more interesting to treat. So the literature explains how trade evolved during post-independence period, and also how its volume decreases during the two last decades with the emergence of BRICS. So this is what we are going to see with these graphs. So these graphs present export patterns and import patterns for former colonies with Great Britain, with France, and with BRICS. So in blue, the blue line shows the exports from the French former colonies to France, and the green line presents the exports of British former colonies to UK. So what we can see is that the volume of exports from British former colonies to UK is more important than the volume of exports from French former colonies to France. And again, when we look at the evolution of exports from French former colonies to BRICS and British former colonies to BRICS, we can see that the exports from British former colonies to BRICS is far more important than the free other flows. And we also have the same patterns for imports. Again, when we consider BRICS countries and their relationship with other developing countries, whether those BRICS countries have been former colonies or not, so the former colonies are, for example, Brazil, South Africa, India, they may share some historical, institutional, and political ties with other former colonies. Again, when we think about colonization, colonial legacy, one important feature that stands out is the following. They have the possibility to have an anchor with the currency with the former metropolises. Thus, when we look at the literature of international trade, we saw also that there are several papers that have been interested in the impact of exchange rate regime and volatility on trade patterns. Therefore, we raised the following research question. Our research question comes in 2 points. So the first research question will be the following: how do trade relations with BRICS countries and the legacy of colonial structure influence trade flows of former colonies? And the second question is, how do exchange rate regimes and exchange rate volatility affect trade of former colonies? So to this research question, we set the following hypothesis. We think that trade flows with former French and British colonies have increased with BRICS trade, but also have been influenced by colonial ties like language. Exchange rate regime and volatility do play a role in explaining international trade. First, we think that volatility has a negative impact on trade because of uncertainties. However, structural trade pattern could lead to positive impact. Exchange, and again, we think that exchange rate regime, particularly fixed ones, can negatively affect trade due to restrictive policies that frequently accompany such arrangements. So to answer our research question, we first look at the literature. So we are going to organize the literature into 3 parts. The first part of the literature is devoted to trade pattern between France, Great Britain, and former colonies. So there have been many papers on these literature, I mean, trade patterns between those former metropolises and former colonies. One of the first papers we can quote is the one of Lyman in 1976. He studied the trade before and after independence and concluded that former metropolises were favored. Why? Because, as I explained in the beginning, one of the first sector, one of the first elements of the economy that will last after the independence will be trade, because it's structural and it's due to the relationship set between former colonies and former metropolises. So, more recently, Atto and Blanton in 2002 confirmed persistency of trade with the former metropolises, but insist on the fact that British colonies diversified quicker. And this is related to the colonial rule, the colonial rule, I mean the British colonial rule, which was less restrictive than the French colonial rule. And that's why, after the independence, British former colony will tend to diversify their trade partner. Again, when we look at Infante and Mate and Krausman and Head and Hall, they will confirm a decline between 40 and 65% of trade between former metropolises and former colonies from the 1960s to the 2010s. And they explain that this is a new trend of trade between the former colonies and the former metropolises. And other authors, Rao and Bertu Erhard, will also analyze trade pattern of developing countries, former colonies, and they will say that there is a new evolution which tend to be for those former colony. I mean, those former colony become to display new trade pattern. The evolution is different in the sense that it can be explained by trade network. So, what do they heard by trade network? They explain it by the fact that former colonies become to have new trade partner, and this new relationship, this new trade partner can be explained by the fact that those countries are the economic partner, they share common language with those countries, there is a kind of proximity, there are also facilities in telecommunication and transportation. So, with all these evolution in the literature, we can see that there is also an evolution in trade pattern between former colonies and former metropolises. And also in the international economic scene, if I can express myself like this, we saw those last years, 20 years ago, even more, 25, 30 years ago, we saw the emergence of new powers that have some specificities because they are former developing countries and they are transitioning towards developed economy, industrialized economy. So there are BRICS countries, Brazil, Russia, India, China, and South Africa. So papers will be written on their emergence. So overall, we talk about their emergence, the type of economic power they're set on the international economy. So Cochrane and Zaidan in 2024 talks about BRICS like emerging power that appear as alternative trade partners for former colonies, and they present themselves to those former colonies as former developing countries. So the idea is to have a special relationship with these former colonies and to explain to those former colonies that they have an alternative. So they seem more attractive to those former colonies. Again, we have Mangani, who talks about BRICS global governance. And he says that the global governance of BRICS, the way BRICS enter in global governance is different from the other economic power because it is characterized by multilateralism, regionalism, and anti-imperialist views. And this last view, anti-imperialist view, is very important for this country because it's the way for them to be very attractive to other developing countries and to build ties, new types of economic ties with these developing countries. Now, the third point of the literature that could shed light on our research question is the literature on exchange rate regime and volatility and international trade. So there have been many papers that have been written on that. The first group of papers will be interested in currency arrangements that appear as a lasting tie between former colonies and metropolises. So we can quote the example of CFA franc zone countries. Indeed, there is an advantage for a developing country to peg its currency to the currency of a developed economy, which is a stronger currency. So the advantage is to import the credibility of the strong currency. Okay, so the former colony, the idea of the former colony will be to, by pegging their currency to the currency of the former metropolises, to import the credibility of this currency. Now, there is also an advantage for a developing country to have a flexible currency. Why? Because a flexible currency will behave as an automatic stabilizer. It means that whenever there will be an external shock for this country, and we know how developing countries are sensitive to external shock, this flexible exchange rate will be an automatic stabilizer, will allow the current account to equilibrate, to come back to the equilibrium. Now, what is interesting in this discussion is the fact that in 2012, Longkeng made a paper on CFA country zone, and he explained that those countries will have more advantages to peg their currency to a basket of currency made up with currencies of BRICS countries. Why? Because when he analyzed trade patterns of those countries, he saw that the last years, so it's the last year, the decade 2000, he showed that there is a kind of reorientation of their trade flows towards BRICS. Okay, so because of that, as we explained, if they peg their currency to BRICS, they will gain a benefit in trade in trading with this country because they will be protected against currency fluctuation. Okay. Now we have another paper that talks about currency talked about the fact that when a developing country pegs its currency to the currency of a developed country, there is, of course, this advantage to be to protect itself against uncertainty, exchange rate fluctuation if it trades a lot with this country. But there are some constraints, and one of the constraints is that this country have to accompany this currency anchorage to protectionist trade measures on imports because it has to protect the pegging of this currency. And again, the final thing I would like to say about this part of the literature is that the type of exchange rate regime determines the strength of the volatility amplitude. Because when you peg your currency with one currency, it's a fixed exchange rate, but it means that it's not really a fixed exchange rate with other currency. Okay, so there is an impact of pegging with other or on the flexibility on your currency with other currencies. Now, the second part of the literature related to exchange rate I would like to talk about is the part related to volatility. So there have been many papers on exchange rate volatility and trade flows. How does exchange rate volatility impact trade flows? How does it impact international trade? So many papers have been written on that, Chowdhury, Kote, Nichita, Geldner, and the results are mitigated. Some studies find slight negative impacts. Some studies find non-significant impacts. Moreover, what is important to keep in mind is the fact that results depends on the econometric method. So there are some studies that will pinpoint the fact that it's important to have the right econometric method and to know what you want to study. Pay attention to the long-term, short-term impact of volatility. Okay, so now that we have a broad picture of the literature, we know what has been done on the different parts of the literature. What I am going to do is to begin with the methodology, and I will first talk about the data. So our data, the main source of data is the databases of CEPI, BESI, which is a databases related to bilateral trade flows between countries. We also use the World Development Indicator and the IMF article for consultation for the exchange rate regime. So our panel data set span is the following: 1991 to 2021. As I said, it's a panel data that is related to former colonies. So we have 36 former French colonies, 51 former British colonies. And we also had to construct a longer trade variable. Why? Because the language variable that we had in the CEPI databases was common official language. So we wanted to grasp there are some aspects of trade language that were not grasped by these language variable provided by CEPI. So we constructed a language trade variable. For example, if you take the example of French former colonies, the variable specifies if trade happens via a directly shared BRICS language. So there is one modality, and the other one through English as a trade language, through French as a pragmatic bridge language, or in the absence of any common trade language. So we are going to check all those modalities of the trade language. So what we are going to do here is to run a model which is a gravity model. It's not really a gravity model because it's not about bilateral trade, but we will, because we wanted to analyze the impact of BRICS trade and other characteristics of BRICS trade on the trade flow of the former colonies. The dependent variable will be trade flow of the former colonies. Yes, trade flow of the former colonies, export and imports towards the rest of the world. Okay, so we relate trade flows of a former colony with the rest of the world to common explanatory variables of gravity model, plus the following variable of interest, which are a dummy for trade with BRICS, a dummy for exchange rate regime, the log volatility of the exchange rate, as well as log volatility cross regime type. So we test these, the trade language variable, and a dummy for colonial siblings. It means that in our paper, we are going to check also if for the former colony, trading with another former colony impacts its trade flows. So we estimate a PPML, which is the Poisson-Pseudo maximum likelihood, which accommodates for zero trade flows and also heteroscedasticity. Our model is the following for French colonies, so the one that is displayed here. So we will run 4 models for French colonies, exports and imports flows, for British colonies, exports and import flows. So this is because of the volume of the data. And in the literature, it is what is commonly done. So these are the regression that have been made. So for exports of French colonies and British colonies. Okay, so as I said, it's a very preliminary version. So what I'm going to do is to interpret the results. So our variable of interest first are trade with BRICS countries. So BRICS, the variable BRICS trade has a positive significant impact on export flows, which highlights the importance of trading with BRICS for former colonies. And what is important to know is that BRICS trade coefficient is more important for former British than French colonies. And this is something that was seen with the graph I showed in the introduction. Now, concerning the exchange rate variable, exchange rate volatility has a negative impact on export for former British colonies, which is consistent with uncertainty in the sense that many former British colonies are floating exchange rate, and floating exchange rate, the disadvantage of floating exchange rate is uncertainty. So the negative impact is even stronger when the dummy is crossed with the dummy of exchange rate regime as opposed to French colonies. But what is important to know here when we analyze all those results is the fact that, of course, those results are contrasting, but they may be explained by the fact that former French colonies trade more with countries with whom they share a peg currency, which dampen the negative effect of volatility. Again, when we look at the sample of French former colony, you can see that they trade more with their siblings or their network trade partner. Okay, so this can explain the fact that they are less subject to exchange rate volatility, as most of the French colonies, they have a peg currency. So when they trade with partners that are part of French network, we can think that the currency, the peg of the currency play a role. Okay. The pegging of the currency play a role. Now, when we look at language, we see the following we can say the following interpretation. We see that sharing a common official language has a positive impact on trade for both sample. However, the coefficient is more important for British former colonies. And we also see that English as a trade language has also a positive impact. So here, what will come out from the result is the fact that English is really an advantage for those countries that have English as common language, and even if there is no English as official language, it will be the language that will be used for trade. And again, French as a trade language does not increase substantially trade. So this was one of our results. And again, having no common trade language has a positive impact on exports, reflecting the structure of contemporary export patterns. So what does it mean? It means that there are some countries that won't use a language, which is stated. It's not a chosen language. They will trade. They won't be a declared common trade language, so they will trade. But this trade happens because of structural issue. Because, for example, they are resource exporter or resource importers. Because they enter the global value chain. So the language doesn't really play a role, but it's just because of structural pattern of trade and the evolution of trade. Now, the trade network. If we want to talk about the result related to the trade network, so former British colonies tend to export more than former French colonies. The coefficient of exports between former British colonies is significantly negative, indicating higher export towards non-British former colonies. And on the contrary, the coefficient of exports between French former colonies is significantly positive, indicating higher export towards French former colonies. So again, okay, yes, for this part, what is important to mention is really the trade pattern with the British former colony. Again, to explain the difference between British former colony and French former colony, we have this persistency of the colonial rule, the restrictive colonial rule, in the sense that French former colony tend to stay in the French networked trade, and the British, on the contrary, the British former colonies will tend to diversify more their partner, their trade partner. This is why we have these results. Now, as for imports, so we look at the result for, these are the regression for French former colony and British former colony for the import side. And what we can see is we have almost the same pattern. So for BRICS partner, French former colonies display a higher coefficient than British former colonies, indicating a different structure in trade with a bias toward import. It means that when it is about import, French colony, we tend to import more, and we'll have yes, we tend to import more, and we'll be more open. And finally, for exchange rate volatility has a negative impact on former British colonies. The negative impact is even stronger when the dummy is crossed with the dummy of exchange rate regime, as opposed to French colonies. And again, this is consistent with the idea that French former colonies trade more with partners with whom they share the same currency, on the contrary to British former colonies. So, for language, we have the same pattern. English appears as a language that has a positive and significant import on a positive and significant impact on imports. And French is not, French is not really significant. Former British colonies tend to import more than French former colonies. And again, having no common trade language has a positive impact on imports, reflecting this structure of contemporary import patterns. Finally, for the trade network, the dummy indicating trade between two British former colonies has a negative impact on import, indicating that British former colonies trade more with patterns out of the British network. And the dummy indicating trade between two French former colonies has a negative impact on import, indicating weak intra-trade between French former colonies. Yes, this is also an important pattern, and it shows how the persistency of the colonial rule influence trade patterns with former colonies. So to finish, we made some robustness checks. We add, in addition to other gravity, common variable, we add governance effectiveness. We saw that it had a positive impact on the imports as well as the exports flows for all former colonies. We try to integrate to control for commodity price index, and we saw that there was a positive impact on trade flows for all former colonies. So we had the idea to calculate the volatility of commodity price index to make the robustness checks. It will be for our next our improvement of this paper. And finally, we also test from some interaction terms. We made the following interaction term. We cross BRICS trade, trading with BRICS country and exchange rate volatility. We saw that it was non-significant for all former colonies exports. On the contrary, when we make the three-way interaction term, BRICS trades, exchange rate volume, and exchange rate regime, we can see that there is a negative impact on former French colonies exports, but positive for former British colonies, which pinpoint the exchange rate regime, the PEG regime, the fact that for most of former French colonies, they choose a pegged regime as opposed to most of British former colonies that will choose a flexible regime. So we can see that there is an impact in the sense that the negative impact for former French colonies can be explained by the fact that French colonies have to set aside to accompany their anchorage, they have to accompany them with restrictive trade measure. Okay, so at the end of the day, it has a negative impact on trade. And this is something that is consistent with the data we saw, because trade flows for French colonies is much lower than trade flows for British former colonies. So we did the same. Yes. Okay. Okay. So we now conclude the study, the paper. So I will conclude the paper by saying, by raising 3 points, three main results. Trade flows of former colonies are significantly influenced. They have increased because of the increase of trade with BRICS. Okay, so we can see it's a striking feature of international trade. So trading with BRICS has a positive impact on trade flows of former colonies. British former colonies are more involved in trade with BRICS, and we can also explain it by the fact that it's a kind of persistency of British colonial rule, which tend to be less restrictive. So the British former colonies tend to be more diversified and tend to be also more present on international trade, on the international trade scene with other countries. And also, it can be explained by the language, because English is an economic language, is a business language. It's also a language that is used in trade. And finally, what we can say is the fact that exchange rate volatility has a negative impact on former British colonies, because they tend to trade more with countries with whom they don't share the same currency, as opposed to French former colonies. But at the end of the day, as we can say, they are much more dynamic in trade. And when we cross the exchange rate volatility and the exchange rate regime, we can see that at the end of the day, the result for British colony is positive. So this is something important to say. So, as I said, this is a preliminary work. We wanted to do more with this work. So our direction for future research is the following: is to make the gravity model with bilateral trade between French former colony and BRICS, British former colonies and BRICS. The idea would be to analyze which features between those two groups of countries play a role in the bilateral trade. So thank you for your attention. And I will be open to answer to your question. Thank you.
Yeah, Yusuf, please.
Okay. Sandrine, thank you very much for this really interesting piece of work. Actually, it's really interesting. Actually, I mean, basically, in terms of, I didn't see any mention of the political economy. I mean, on what you present actually, right? I mean, because you do know that. I mean, when we talk about those former colonies and so on, there is a lot of things we can say about the political economy, the dynamics of that, and how that actually will impact. I mean, the trade with others and so on. I mean, probably. I didn't. I mean, you didn't talk too much about that. I mean, probably that will be interesting. And another thing is basically, of course, that's kind of linked to the fact that there are maybe former colonies, but the legal environment, you know that, I mean, French countries actually, they are following the civil law, and there is a literature saying that probably the common law is much more really a business enabling, actually, and then how much that plays actually. I know, of course, it's linked to the fact that there have been former colonies, but this is kind of endogenous now, right? I mean, they have already adopted this way of doing things and so on, and how much of that, actually plays out actually. And then another thing is the trade arrangements. I mean, I didn't hear you about the trade arrangement because, even with those French colonies, right? The French colony, if you look at, for example, in Africa, we have mainly two blocks, right? I mean, the West Africa and then the Central Africa. Of course, both of them have CFAs, but if you look at the dynamics on the two blocks, they are completely different, right? I mean, actually, one of the blocks is more advanced and so on. But I think, we can say more about, what is going on. And then you said, actually, the trade colonies trade among themselves a lot, actually. I'm even curious to see how much, when you say a lot, how much is that? Because we had a paper, recently, last year, where actually we showed that, the internal trade really is very, very low among those countries, actually. Then when you say they trade among, themselves a lot, I'm curious to see, the size of that trade actually, because it looks like, and also the trading with the Brazil. I think it will be interesting to see how much of this is the China phenomenon, right? Basically, if you can, I think it will be interesting, to control somehow for the China phenomenon. Maybe it does not, because some of them had a relationship with Russia, for a long, long time, based also on geopolitical, politics, and so on. But I'm really curious. And then last question I had, I was about to say, but that was wrong actually. I was about to say that the BRICS countries, because some of them had former British colonies, but not many of them, right? Brazil is not, Russia is not, China not, actually maybe India and South Africa, but that's one we can skip that. Basically this will be my few comments actually on the paper.
Okay. If you allow, I will answer instead of taking many comments. So your questions are very interesting. Most of them, I will take them into account to improve the paper. As I said, we had some issue with the data, treating the data, so it takes too much time. Yes, of course, we have to take into account common law and trade arrangements because it may play a role in what we are studying. Now, of course, we thought about those political arrangements. I didn't here present the other control variable because I wanted to stress on the main result, and we were interested on the impact of trade with BRICS, but also language and exchange rate volatility. But surely this is something that we will take into account to improve the paper. We thought about this issue of political economy, but also the issue of soft power, and this is one of the future paper, one of our future paper, because when you look at those BRICS countries, you can see that besides trading with former colonies, there is also other economic relationship, like for example, foreign aid, like even cultural ties they are doing. For example, China is setting many Confucius centers in many countries, and there is a kind of soft power that they are playing, a game of soft power they are playing to increase their influence, to increase their economic relationship with those countries. So this is the second paper we are working on, but definitely I will take into account your comments. We thought about thinking more with China, because China is the big giant among those 5 countries. I will look at Brazil too, and for concerning the impact, the positive impact of trading between the former colonies, it's just to say that they trade among them, and it's more between British colonies than it's more between French colonies than British colonies. But yes, trade data say that there is not many trade, but it was just to say that when we look at the trade pattern and we look at French colonies, they trade more among them than British colonies that will tend to diversify. I mean, this is what the coefficient was capturing. But I will take into account your comments about trade arrangement and looking also about political economy and Brazil, the case of Brazil. For China, we took it into account, but Brazil is also an interesting case to look at. Thank you.
Yeah, thank you very much. And Joseph, thank you for saving the seminar today even. And thanks, Sandrine. I saw Jeffrey hands on, and then Martin, please. So Jeffrey, you're first.
Thank you, Bill, and thank you, Sandrine, for your presentation. I really enjoy it because I learned a lot from the analysis. I have 2 questions, or should I say comments for you. The first one is going back to the very first graph you show. That graph, you observe a very sharp increase in the former British colonies with the BRICS. So, and I was wondering if there's a way that you can dip a little bit deeper. Why that sharp increase? I think that would, I don't know if you've considered that, but if you haven't, I think that would be a huge contribution of this paper, because it wasn't like it was growing over time. The increase, yes, as you can see here, that increase was very sharp. Something happened during that time, because I know that, yeah, and just to extend that one a little bit, it's the trade from former British colony, if it's possible for you to separate the trade from South Africa in particular, because not only because South Africa is mainly one of the trade countries that the trade is reported in East Africa, but because South Africa is one of the founding members of the BRICS, whether that is covering the trade. If you remove South Africa from your analysis, then you see other non-BRICS members, so that you can see the actual effect. And the last comment is about treaty within Africa, because I think that is sort of related to trade arrangement mentioned by Isu, because treaty is something that maybe it would, if you control for treaty, to see how that shape your results. Because why treaty is different from other dynamic variables in your model is that when countries sign, it means there is possibility that we trade with countries that they would normally not trade with. So if you can, especially the recent treaty introduced by Africa, whether that will also affect your result. And overall, thank you. I really enjoy your presentation. Thank you so much.
Okay, thank you, Jeffrey, for your question. Yes, about the treaty, I think they goes with the question of Yusuf. So I will try to integrate it in the analysis. Thank you for the comments. Now, concerning the trade with South Africa. Sorry? Concerning the trade with South Africa, yes, it's something that we can consider. I don't know if it's relevant to do that, but we can do that just to see what it represents, how it changes the results. Again, I have to say that yes, when we are talking about it, former colonies, they are not only African colonies. You also have other former colonies. I mean, in other continents, Asian, etc. So we consider all those colonies in our analysis. So in taking into account the treaties, it means that we will have to look at treaties in Africa, but also in those countries, in those regions. But I will take it into account. We will think about how to integrate it in our study. Now, for the evolution of trade, yes, I must avoid that we didn't spend time to try to analyze why we have this dramatical increase of British former colonies with BRICS. British former colonies trade with BRICS. But 2000 is a year of strong emergence of these BRICS countries, and as element of answers, I can say that this period was a period of strong emergence of these BRICS countries. So with this emergence of these BRICS countries, you have trade in natural resources, especially with African countries. Of course, they are not only trading with African countries. In our sample, there are not only African countries, there are other former colonies, but we talk also about the global value chain in which other countries may be part of, and which can explain because of the really strong emergence, strong growth of BRICS countries. Because I remember that during this period, the price of natural resources increased, commodities increased, and it was due to the strong growth of those countries. So I think that it may be one of the explanation, an explanation that says that those countries were really growing at a really high pace. And because of that, their industry needed commodities, but they also needed to have a new commercial partners, and this could explain this strong growth of exports and imports. But again, it's just some elements of answer. So I will try to think about it and to analyze why we have this increase. But I think you have some of the answers here.
Yeah, thank you. So thanks, Jeffrey, for the question, and Sandrine for your explanation. I remember, Martin, you have a question, right? Can you please come in?
Yeah, thank you. And thank you, Sandrine, for that very interesting presentation. I have two questions, one which follows on from the previous discussion. But first, can I just ask you to clarify about the data in the regressions? Is each observation a separate country and a separate year, or are the observations groups of countries? You know, the British colonies, the French colonies, etc. And then, with regard to the this graph, I think that graph is mirroring the global price of oil. We saw the very sharp build-up in the 2000s up to around 2014, and then the drop, and then the rise again after the Ukraine war started. But oil is not really sold on bilateral markets. It's sold on a global market. So would it not make more sense to remove oil from the data? Because isn't including oil, which is such a large share of trade flows, especially from Africa. At one point in the 2000s, it was almost 50% of African exports. Isn't that sort of distorting the overall picture? Thank you.
Okay, thank you, Martin. Very interesting comments and question. Thank you for the light you shared on the graph. Yes, I think that yes, it was part of my answer too. The surge of, the dramatical increase of exports could be explained by resource price, and also the trade with between BRICS and other and former colonies. But concerning the data, yes, this is one question that we thought about, and we don't have sectoral data. With the trade data we had, we thought about working on sectoral data, but in another paper. So it means that here, with the data we've worked with, there are only aggregate data on trade. Okay. Now, as I explained for the dependent variable, for the dependent variable, is the exports. The dependent variable is the export of the concerned country, the former colony I at year T. So if it's exports of the former colony I at year T to the rest of the world. Because at first we wanted to see how BRICS trade and all those features that we mentioned in the study influence trade flows of these former colonies. So this is the dependent variable. And then for the variable related to capture, for example, variable with BRICS, we use a dummy variable. And that's why we say that a second interesting analysis that could be interesting to do will be, instead of considering the trade of the former colony vis-a-vis the rest of the world, it will be interesting to see bilateral trade between the former colony and each BRICS countries, because this will help us to have another view on. We will be more able to grasp the features, what influence those trade, what explain these trades. And again, to come back to the data, to come back to your second question, I don't think with the data we have currently, I don't think that it's possible to withdraw oil from the data we have. But we can consider, and we thought about considering another analysis, which could be a sectoral analysis. For example, considering trade on raw material, on natural resources, on industrial manufacturing products, and so on. Okay, so this is something that we thought about, but for the current data we have, we are not able to disentangle between the components of trade flows.
Okay, so Sandrine, so just to continue with your answer to that oil. So if you know the sector information, the trade information on the sector level, so you know the oil export and import, so you can just subtract this sector's trade from the total trade. Can you do that? So you can still do the country level by taking away the sector, the oil sector trade.
I can do that, but what I was meaning is that for the current analysis, it's like if we look at part of trade, but what we wanted to look was total trade. Now it's something that can be made, but maybe in another paper, or I don't know, maybe we can do it as a robustness check. So I can think about it like that.
Yeah, that's really good. So thank you for all the questions. So Martin, are you okay with the answers, right? You have another query or something?
No, thank you very much. That was a very clear answer, Sandrine. Thank you.
Great. Thank you very much for the question and the answer. Actually, I think I did not see more hands, so maybe I should comments. Should at least ask a couple of questions. So I think this is a very interesting paper, and there is a lot of opportunities to dig deeper. So, for example, Sandrine, I was looking for more about colonies. So you are arguing it is the colonial regimes that are still influencing the trade pattern between former colonial countries and BRICS. So, and then you choose one important aspect of the economic aspect, and that is the exchange rate and the volatility. I was thinking, if you take the colonial aspect out of your paper, does your story still hold? Because we are still talking about the exchange rate volatility and exchange rate itself and the volatility and their impacts on trade. So I was wondering, why do you need this colonial regime? Because the problem is still here. So I do not see that aspect. And yes, you add some language as a control variable, but I think the core variable is the exchange rate and the volatility. So can you explain a little bit more why did you choose this exchange rate or volatility and to talk about something about the impact of colonial regimes?
Among the variable you have, but I explained in the beginning, the fact that currency arrangement is one of the one feature of colonial persistent ties between former colonies and former metropolises. So it's something that I wanted to highlight because, of course, I'm specialized in finance, macrofinance. So, of course, for me, it is something interesting to look at. And I think that there are many papers that have been interested in exchange rate, volatility, exchange rate regime, and trade patterns. For example, the paper of Longkeng. So I thought that it was something interesting to pinpoint. Also, the idea of language and to also look at the relationship between BRICS countries because they are emerging power, because anytime we listen to the speech they are having with former colonies, they talk about the fact that they are not they won't set with those former colonies the same relationship than the former metropolises. So for me, it was something interesting to look and to see whether or not this aspect was impacting the relationship with BRICS. Now, it's true that, yes, we have to take into account other variable, and I think Yusuf was very I don't know how to say it, was very kind to mention it as something that could improve the paper. So it's something that I will do. But I think that the exchange rate arrangement is something that is very important, because if you heard to discussion, how can I say it, economic discussion and even political economy discussion that are take concerning former colonies, you have this issue of exchange rate arrangement, which is something that comes from from the colonization. So for me, it was something important to pinpoint. And of course, yes, I have to take into account other variable to have it to improve the paper. So this is what I can answer.
Yeah,
So,
thank you very much.
yeah.
So, Sandrine, talking about the trade, we have a lot of currently debated issues, such as, what are the impacts of the current trade war? So can you talk about the policy implications of what you have done in this paper? So what are the policymakers should consider their policies based on your results?
Okay, I didn't thought yet about the policy implication, but it still shed light on the debates on currency arrangement, because we found many results related to that. Which shows that French former colonies trade less. They trade less because they stay in the French network trade, and this is because of the trade, the currency arrangement. I think because there are other consequences of this currency arrangement. So this is something that can shed light on the debate, because if you listen to what is said on the international economic scenes about CFA currency arrangements, sometimes people talk about the fact of leaving this arrangement because they say that it's an old fashion arrangement. And the paper of Lonquin showed that, yes, there is something to do about that, because there is a reorientation of trade of those countries. And because of this reorientation, it will be interesting to consider another basket of currency for these countries to peg their currency to this new basket of currency. So I think that I don't have policy recommendations for the time being, because the work is preliminary, but still this work helped to shed light on debates like currency arrangement of former colonies, debates as maybe former French colonies should try to trade more with other partners than the French network partners. And so this is what I will have to say about language. There is also some interesting results. We say that there is an evolution of international trade, which makes that even though countries don't share the same language, they will trade because they will be part of a global value chain. They want to integrate it. They will serve natural resources. So I think that all these are our results are elements that shed light on trade, international trade debates. And of course, when I will finish the paper in a more advanced version of the paper, I will set some policy recommendations. But as I said, this is a very preliminary version.
Yeah. Okay. But but I heard a lot of good connections. So I think particularly you choose exchange rate and volatilities. So I think naturally you can connect this with the international payment system. Look at how they treat now. They do not pay by US dollars. Many of them, they are paying by their own currency, by swap, for example. So yes, I can see a lot of policy implications here, and then the debate issues here. So I think, so do we still have any more questions?
So I'd like to thank you all, because the discussion was very interesting. The comments were very interesting. Questions that were asked were also very interesting. So I hope that you enjoyed the presentation and you learned from something. And surely I will integrate all your comments, because this is this is the final aim of this presentation. And thank you, Bo, and thank you, Meng, for having given me the opportunity to present this preliminary version of the paper. Thank you very much.
But thank you very much, Sandrine, and thanks for very structured presentation and a very interesting topic.